Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aeva Technologies Inc. Annual Report. Aeva Technologies Inc. is a leading provider of LiDAR sensing systems and related software solutions. The company's products are designed to enable perception and autonomy in various industries, including automotive, consumer devices, industrial automation, and security. At the heart of Aeva's offerings are its LiDAR sensors, which utilize frequency-modulated continuous wave (FMCW) technology. These sensors include the Aeva Omni, a wide-view short-range 4D LiDAR, the Aeva Atlas, a long-range 4D LiDAR with data and power over Ethernet, and the Atlas Ultra, a high-performance 4D LiDAR sensor for SAE Level 3 and 4 automated driving systems. In addition to its LiDAR sensors, Aeva offers software solutions that enable real-time traffic intelligence and improve safety, efficiency, and data-driven transportation planning in cities. The company's CityOS is an AI operating system designed specifically for this purpose. Aeva also provides a range of other products and services, including the Atlas, a FMCW 4D LiDAR with simultaneous velocity and range detection. Aeva Evone, a line of high-precision, laser displacement sensors for volume industrial automation, and its Atlas Ultra sensor, which is built to meet the performance demands of SAE Level 3 and 4 automated driving systems. Overall, Aeva Technologies, Inc. offers a comprehensive suite of LiDAR sensing systems and related software solutions that are designed to enable perception and autonomy in various industries. Aeva Technologies, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Aeva Technologies, Inc. trades at a higher price-to-book ratio of 64.43 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, successful commercialization of R&D programs and adoption of Aeva's products by customers are crucial factors. Effective management of sales volume and market demand also contributes to revenue growth. Additionally, an increase in units sold and activity related to non-recurring engineering services have a significant impact on revenue. On the decline side, anticipated losses on contracts, decrease in revenue due to competitors offering similar products, and adverse outcomes in litigation related to intellectual property rights are major drivers of revenue decline. Changes in customer acceptance requirements also contribute to revenue decline. Market growth in North America, Asia, and Europe is a significant driver of overall market demand. The top 3 customers account for a substantial portion of revenue, indicating their importance in driving Aeva's revenue growth. Financial factors such as an increase in contract assets and decrease in vendor deposits also play a role in revenue growth or decline. Overall, these drivers highlight the complex interplay between various factors that influence Aeva's revenue growth or decline. The company's financial performance has been marred by consistent losses since its inception. The net income has decreased significantly over the past 2 years, with a decline of $6,970,000 from 2023 to 2024, and another decrease of $7 million from 2024 to 2025. This downward trend in net income is a cause for concern. profit margins have been uncertain due to various factors such as market adoption of LiDAR technology, pricing pressures, and OEM cost reduction initiatives. The company's inability to achieve profitability can be attributed to these external factors. Furthermore, the expected variation in profit margins across different markets and applications adds to the uncertainty. The company's operating cash flow has been consistently in the red over the past 3 years. The data from 2025, 2024, and 2023 reveals a pattern of negative operating cash flow, with amounts totaling $115,000 and $77,000, $106,000, $913,000, and $118,826,000 respectively. This trend indicates that the company is struggling to generate sufficient cash from its operations to meet its financial obligations. As a result, it can be concluded that the company is not generating positive operating cash flow. The company's financial health has undergone significant changes in recent years. A notable increase in debt level is evident from the data provided. The total debt has risen substantially from $48,137 in 2024 to $166,486 in 2025, indicating a substantial growth of approximately 245%. This surge can be attributed to the issuance of convertible notes with a principal amount of $100 million. Furthermore, interest expenses have also seen a significant change. The data shows that interest expenses have increased by $0.7 million. Additionally, the company is accruing interest on the convertible notes at an annual rate of 4.375%, payable semi-annually. This development suggests that the company's financial obligations are becoming more burdensome, which may impact its profitability and cash flow in the future. The performance of various segments and regions has been a mixed bag. On the positive side, North America has consistently shown high revenue percentages over the past 3 years, with no significant decline in sight. Europe has also made strides, improving its revenue percentage from 18% in 2023 to 21% in 2025. However, other regions have struggled. International markets have been plagued by operational, financial, and regulatory risks, leading to poor performance. Asia's revenue percentages have decreased significantly over the past 2 years, dropping from 17% in 2023 to a mere 3% in 2025. Oceania has also failed to make significant gains, with its revenue percentage remaining low at 2% for both 2024 and 2025. These disparities highlight the need for targeted strategies to address the unique challenges faced by each region. By understanding the strengths and weaknesses of different markets, businesses can develop more effective plans to drive growth and improve performance. The management of the company is optimistic about its outlook, despite expecting continued operating losses due to significant investments in product development. The company plans to expand into new markets through strategic partnerships, such as the recent collaboration with LG Innotek Co., Limited. This expansion will be facilitated by increased manufacturing capacity through third-party manufacturers. Management believes that the company's liquidity will be sufficient to fund its operations for at least 12 months from the date of issuance of the consolidated financial statements. However, it is also expected to continue incurring operating losses due to these investments. The company's strategy appears to focus on expanding its business through strategic partnerships and investing in product development. The management's outlook suggests that the company is committed to growing its business, even if it means incurring short-term losses. This growth will be driven by the expansion into new markets and the development of new products. However, the company must also navigate potential risks and challenges, including compliance with public company requirements, regulatory changes, intellectual property protection, and liquidity risks. The company has made significant transactions through acquisitions and divestitures. In terms of acquisitions, the most notable one is the purchase of certain intellectual property, specifically patents, for a cash amount of $4.5 million. This strategic move aims to enhance the company's portfolio and potentially boost its competitive edge. On the other hand, the company has also engaged in divestitures, which involve selling off assets or shares to other entities. One notable example is the sale of $32.5 million worth of common stock to LGIT in August 2025. This transaction demonstrates the company's willingness to adapt and adjust its financial structure as needed. The company's financial activities have been notable in recent times. One significant development is the payment of dividends to holders of preferred stock. This move indicates that the company has prioritized rewarding its investors, particularly those with a higher claim on assets. In addition to dividend payments, the company has also engaged in share issuance. This means that new shares were issued, potentially leading to an increase in the total number of outstanding shares. Concerns about inventory buildup and supply chain disruption are prevalent in the industry. Inventory buildup is a significant issue, with multiple instances of excessive stock levels exceeding customer demand, leading to potential write-downs or write-offs. This problem is further exacerbated by fluctuations in demand for products, component shortages, price volatility, limited suppliers, long lead times, and inventory levels increasing significantly from $2,345,000 in 2024 to $5,787,000 in 2025. Supply chain disruption is also a major concern, with risks associated with international sales and operations, including exchange rate fluctuations and political instability. The industry is susceptible to supply chain disruptions caused by changes to tariffs and trade policies, which can have a significant impact on revenue recognition. Manufacturing or supply chain constraints may also affect revenue recognition, highlighting the need for careful management of these risks. That concludes the financial summary for Aeva Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.